Hi, this is a presentation for Capital Market Regulation. We are presenting on FinTech, the future of financial industry, current regulations and future challenges, the blockchain case.
I am Pietro Canelli.
I'm Amedeo Andriollo.
And I'm Mark Reinhardt. What is financial technology, commonly known as FinTech? Digital and technological innovation is radically transforming the financial industry. Technology enables the creation of new innovative enterprises. This poses new challenges for regulation. The banking system, as we know it, might become a thing of the past, as the financial sector is challenged by new ways to provide financial services or new products are offered altogether. Automation, algorithms, artificial intelligence, and smartphone services are among the main drivers of this change. So, legislators and regulators will have the hard job to regulate in a way that does not slow progress, but at the same time does not allow for undesirable practices. Given that the legal framework will always be lagging behind the industry, it should be taken into consideration a market-reliant approach that will enforce self-regulation. For example, the peer-to-peer lending market, as we will get to later on in the presentation. We can see on the right an attempt to outline the key financial technology trends as currently operating.
Let's be more specific about how FinTech is changing the market. First, blockchain technology and digital payments are altering financial operations and infrastructure. Second, big data and developments in machine learning and algorithms are reducing risks in insurance and capital markets. Third, small and mid-sized enterprises are increasingly turning to peer-to-peer lending platforms to borrow and raise capital from crowdfunding platforms online. Also, digital services are reducing costs of fixed physical infrastructure. Fourth, digital platforms and mobile payment facilities are shifting power away from traditional payment services. Fifth, access to credit is being made easier. Aggregator and comparison websites are increasing information for buyers of financial services as well. And lastly, algorithms and robo-advice is taking the human element out of financial advice and decision-making.
All these innovations are certainly going to deeply modify the structure of finance, but will they actually improve it? Let's go through benefits and threats. The main arguments brought by to support FinTech are, first of all, that innovation can increase consumer welfare, reduce transaction costs and need for intermediaries. They can reduce information asymmetries, increase access to financial services and credit. Furthermore, greater diversification and decentralization can make the system more resilient and reduce systemic risk. Finally, there are implications of electronic money to monetary policy, as Kenneth Rogoff points out. On the other hand, it can be argued that innovations pose a threat to the current banking system, and thus new regulatory framework will be needed. Leaving the industry unregulated leaves avenues for consumers to be taken advantage of, with little protection. There is a significant chance of a build-up of risk in shadow banking with little oversight. To bring an example, cryptocurrencies are exploited to commit fraud, money laundering, and finance terrorism, especially since regulations are being tightened in the formal banking sector, making money laundering harder through regulated channels. Last but not least, cybersecurity threats are a growing concern, especially in a network environment. We can surely point out that FinTech poses a substantial challenge to legislation. So how does the current regulatory framework approach it? There are different regulations and rules to different FinTech firms, depending on business model, product, and industry. Specifically, EU institutions and regulatory bodies have actually pushed an interest in understanding FinTech. It is tough, for example, to regulate a decentralized network, such as in the case of blockchain, since there is no single registered body to enact penalties against. There are two pathways for regulatory bodies to respond to FinTech. whether to include FinTech in current banking regulatory framework or treating it differently by placing special rules encouraging innovation. A specific case treated by European Court of Justice is the one of Booket Limited. The court had applied the border competition law that was not specifically provided for a fintech company. Reliance on this kind of sentences can prevent companies to exploit innovation to harm consumers. Another option at hand would be a regulatory sandbox. The European Banking Federation recommended a European-wide regulatory sandbox for experimenting with financial technology as a short-term solution. In light of the European Commission setting up a FinTech task force in 2016 to explore some of these issues, the report called on a comprehensive approach within the framework of the Capital Market Union and digital single market strategies to achieve an efficient and integrated financial system in Europe. The report found as well that same laws should apply to same service or product, that technological neutrality should be preserved, and suggested a risk-based approach. It would be hard to treat all the specific sectors in depth, so we are going to bring as an explanatory example the blockchain tech case. So, how does it work? A digitalized social love story. For centuries, institutions have used ledger to keep records. Since these databases were under central authorities, ledger resulted to be centralized and black-boxed. Digitalization has just made the same ledger faster and easier to use, but they remain qualitatively unchanged. Blockchain offers the same record-keeping functionality, but with a decentralized architecture. Each new transaction to be recorded is bundled together with other new transactions into a block, which is added to the latest link on a long chain of historic transactions. This chain forms the blockchain ledger that is held by all users. Adding a new block to the chain means updating the ledger that is held by all users. Users only accept a new block when it has been verified that all its transactions are valid. If a discrepancy is found, the block is rejected. Otherwise, the block is added and will remain there as a permanent public record.
Now we will discuss briefly the blockchain environment evolution through the two last years. On the left, looking at the pie chart, standing at the GBSIR, blockchain market was dominated by the USA at 13.9% of the blockchain startups were based there. The second most important country is the United Kingdom, with roughly 20%. However, the data does not show any clear sign of startup clustering in Europe or in other countries, even considering the type of solutions startup offers. The lack of clustering could be the result of a very nascent market with relatively few startups. In the center, we can easily see, we are in the 2017, that the 4 European capital cities entered the top 20 startups, as stated by the Global Blockchain Startup Ecosystem Report. On the right, again, we have 2 bar charts. The first one is the starting importance that blockchain assume as most relevant emerging tech. The second one is the growing familiarity in Europe of blockchain technology. Like 30% is familiar too in 2017. Acknowledged the economic and geographic development, let's take a look at 2 legislative actors, USA and Europe. Both of them started from a wait-and-see strategy to a more active and aware approach. Relating USA, 2015, 2 important institutions create task force in order to understand better the blockchain application. The year after, we assist to a recognition of the importance and the efficiency of this innovative tech. 2017 is a very important year because several countries have integrated into their legislation the blockchain tech public usage, also cryptocurrency application of Bitcoin. Relating Europe, 2015, strongly negative approach because of anti-money laundering directive. Then, in the year after, we note a softer tendency, therefore blockchain as an opportunity. This view is also kept in 2017 as the Europe institutions started to deepen their knowledge about blockchain tech. And we are looking in the next slide to IPRS and how blockchain technology could change our lives. Blockchain will impact several areas. We analyze 6 of them. So, first of all, currencies. Trustworthy system through innovative use of cryptography and peer-to-peer networking. The most popular example is Bitcoin, by far the largest blockchain-based used currency. Unfortunately, there are well-publicized problems of Bitcoin. So, for example, price spikes or usage on illegal market, as well as dark web. In fact, European Banking Authority opinion highlighted several risks. However, in 2016, the Committee on Economic and Monetary Affairs recognized a wider potential, well beyond the financial sector. Another is digital context. Against piracy and illegal distribution, thanks to its virtues, blockchain can resolve digital media problems, for instance, managing consumer rights associated with digital products and unique digital artworks. Patents. Granted a not unified patent system, fighting the patents abuse could be eased by blockchain tech as well as implied reduction of inefficiency in recording because of hashing and proof of existence. E-voting. Cheap and secure e-voting system which could restore the link between citizen and political institution. Successful experiment proved the capacity of blockchain tech. Another topic could be smart contract, which are terms of an agreement between 2 or more parties who are programmed into codes that are stored on blockchain there. When certain conditions that are described in the code are met, specific actions defined in the code are automatically triggered. The agreed code or contract, in this case, can only be cancelled or modified under the terms that are already allowed for in the code itself. So it is a new juridical tool, which is self-contained, self-performed, and self-enforced. Last one, we should analyze the supply chains. It is well known the scale and complexity of the system involved leads to a high transactional cost, frequent mismatches and errors in manual papers, as well as losses through degradation and theft. Therefore, blockchain-based applications have the intrinsic potential to enhance supply chains by registering, certifying, and tracking at a low cost but high efficiency rate.
I'll now finish with some concluding remarks and recommendations. New innovations in the financial realm are often unregulated, pushing the system towards a laissez-faire approach, reliant on market discipline for governance. But the lightness of regulations on FinTech and strong regulations on the traditional finance sector create opportunity for regulatory arbitrage. However, there is little evidence FinTech poses a great and current threat to the stability of the financial system. We recommend EU regulatory authorities allow self-regulation within explicit laws that protect consumers with the threat of intervention of hard law if self-regulation is not satisfactory. This allows for greater flexibility and innovation while protecting and guarding against risk. Regulatory sandboxes are popular with the finance industry and are a good solution to the regulatory problem, allowing a supervised safe space for innovation. Furthermore, conflicts of interest should be guarded against, both in terms of principal-agent problems on the part of FinTech firms and in terms of regulatory capture by the traditional finance industry. It is in the interest of incumbent banks and credit lenders to discourage innovations that pose a challenge to their current business model and future survival. Thank you.